What is going on, everybody, and welcome to another weekly update. What I'd like to do in these videos is provide you some upcoming events, some earnings to help you get you prepared for the week ahead. I also do daily updates to get you prepared for each and every day as the market can pivot on daily news. So, with that being said, this week, we've got some interesting information, even though we have chopped quite a bit. Um, Go ahead and pull this up. Got a pretty interesting week as far as some very pivotal information. Now, Monday is Labor Day, so the market is closed on Monday. But Wednesday, we do have the beige book. As far as weight's concerned, I am not too concerned about it, but if the market doesn't move much on Tuesday, I think the beige book could potentially move the market Wednesday. Thursday is really where my interest is this week. We have ECB interest rate decision at 8:15 a.m. Eastern Standard Time. Now, the last time we thought we hit peak, the ECB interest rates came out. It was actually the core inflation came up to show that it wasn't we didn't hit peak inflation. And then from that point, the market pretty much started selling off very quickly. And then only to find out that we also did not hit peak inflation. So these rates, we do follow the ECB very closely when it comes to rate raises. Now, they essentially came in thinking they were only going to do a 25-point basis move, and they ended up coming in at 50 on the last increase after almost a decade. I believe it was about a decade that they haven't raised any interest rates. Now they went to 50, and now they're looking at a 75-point basis move on this report. If that is the case, I would expect that the U.S. would come at 75-point basis move minimum on this report at least. Now, there's some good information. Typically, non-farms. We did have non-farms this week. They are, especially coming from a report that I think was like 500K, dropped down to like 300K now. So the data is very fudged. And the nice thing about what comes out of non-farm payrolls as well is Kathy Woods puts out essentially a video during that time as well, kind of giving her opinion on the economy. And I do value her opinion very much. I know a lot of people don't like her for whatever reason. You may not like her, but a lot of my theses that I build on my own, she almost solidifies my thesis. Maybe that's why I'm biased, because a lot of what she talks about matches up what I've been thinking. And this report that she came out was no different, right? This report she came out was very interesting, and in explaining that a lot of the data is fudged, that a lot of the data we could be getting is because of seasonal conditions. And her example being, if you think about teachers, right? Teachers have been off for 2 months. The school's been out, now school's coming back. So you don't have those gas fees from all the buses that are running from essentially the schools and the students and the parents that have to run their kids around, right? All that is coming back. That is very pivotal. 2 months of no school makes a big impact, and these seasonal conditions that she puts can make the numbers seem very faulty. And it was actually quite interesting, and something I've been talking about was the fact that these expectations are so like dirt low. And I think the way she explained it being is that essentially because of the pandemic, right, our expectations were not high, right? But because of that expectation coming into this year, like, she thinks that things are way worse than what they're actually showing, and I highly agree with that. And that's why I keep saying too that the stock market is not the economy. But we're starting to see it unfold slowly. I've been talking about a pivot, and she's also been talking about this pivot as well, that a lot of stuff is that we're going to see and see slowly. And she also pointed out the same thing I talked about when I talked about Powell. Powell has made it clear. Now, she seems to think that he's doing it to kind of front run people, to kind of keep people in check if they do come back to a 50-point basis move. I don't believe that's going to happen, particularly in this one. because they want inflation down to 2, even though they're going to believe it's going to be high inflation. So around 4, they would like to at least try to get it to by 2023. So I think to be able to do that, they're going to have to come in with at least 2 more 75-point basis moves. She's talking about the impact on housing. Now we have to understand that the impact with housing and these interest rates is starting to roll over, and it's going to take a little bit of time for it to play out, but it is happening. We're seeing that. And she solidified that thesis as well, and essentially saying that bankruptcies and foreclosures are going to be the next potential thing with these rate increases. It really, and she pointed this out, and this is a point I've been making for such a long time. It is between the Fed and inflation. Nothing else matters. Nothing. None of the other data, all the data is lagging. It doesn't matter. None of that stuff matters. This is solely to protect the reputation of the Fed. They don't want to go down in history. I've talked about this a couple months ago. They don't want to go down in history as being the Fed that let inflation run away. So they are going to continue to front run this until this comes down to 4%, till it comes down to the number that they want. And if by chance the numbers peak or they're sitting flat, you can guarantee that they're going to come with another 75-point basis move. Now, a 100-point basis move, I myself, I don't know too much unless it peaks again. If for some reason inflation jumps over 9.1, I think they will come in a 100-point basis move. But if it comes in anything below a 9.1, maybe it floats between 8.5 and 9.1, maybe it comes down to 8, I think they're still coming at 75-point basis move. I think that the rates have to come down to like a 5%, in my opinion, for them to say, okay, we're going to only do 50. And then maybe we do another 50. But this is what the market is waiting on. This is solely one battle. It is clear as day that it's the Fed battling inflation. Nothing else matters right now. And Powell has made that very clear, that they are going to do whatever it takes for inflation to come down. They don't care about families. They don't care about businesses. It is slowly their job to fight inflation right now. And something else I talked about and tried to educate about this a couple months ago too, like the Fed, when they're raising interest rates, they realize that if they raise interest rates, it affects jobs. And she made something very clear too, as far as like when it comes to the jobs. A lot of these jobs that are reported are like part-time jobs. They are not full-time jobs. Like the full-time job numbers are still really low and really bad. Like people are working like junky part-time jobs, like multiple part-time jobs, to try to combat the massive amount of inflation that is in food and energy. And this is the battle we have right now, and continue to see where we go from here. Right, used cars, I think, has come way down because of this transition into EV. And some companies are going to really start getting hit pretty bad. Ford and GM, all these companies that are trying not to make the transition over, are going to be hurting pretty bad pretty soon. That's not saying it's going to be an overnight thing. All these things take time to play out. But just kind of reiterating again what is currently happening. Now, this whole situation with whether we want to believe you're in a recession or not, who you want to believe, that doesn't matter. In my opinion, I think we are in a recession, and I think it's going to be a prolonged recession, especially if the Fed continue to raise rates, and they don't seem to be backing down until they actually show. The biggest difference is they will talk about it. 2 months ago, they were telling inflation was under control, and then you find out it's not in control, right? The data made it seem like it was in control, but it's not. You have to wait and see. Right, you have to see the report, and I think the market is finally getting that. This market's like, let's just wait and see. What is core inflation at? Where is it sitting at? Where's headline inflation? Where's food and energy sitting at? All right, that is where it is. If it's coming down, it needs to come down a lot. A little bit is great. It shows progress, but you need it down to 4%, or things are going to continue to be high. And something else Cathie Woods pointed out was that this massive amount of supply that Walmarts and your Targets, they still have massive amounts of supply, and they still haven't cut any pricing on these things. And they still got a bunch of seasonal stuff coming in. Like they got to start reducing costs. Right? So we start talking about deflation. Yes, we're starting to see signs of deflation, but you have to understand it's not quick. You need like cycles. You're talking like quarterly cycles here, 3-month cycles, right? And so, with that being said, this leaves us for the ECB, and then soon enough we're going to get our core inflation, and then we're going to get our report, and that's what we're looking for this month. And so, with all that being said, we're going to go over a lot of the basic stuff that we do. Again, we got the Beige Book Wednesday, ECB for Thursday, and then the Fed on the end of the month. Upcoming earnings, we do have Zscaler. I'm waiting to play continuation on that. Potentially, I really want to see how the market is and where that is. Could be a potential play. Watch list. SPX is down to 97. Tesla 15, BA7, and JP4. Now, SPX was quite high last week. It's typically sitting around 80, so it's still pretty high. It's still expecting a big move, and I think it will have a big move after the ECB report. So just really kind of watching that. So let's get into some technicals here. So what we're looking at this week, something to keep in mind, this is the new scale I've been kind of using, essentially the Fibonacci levels. What you'd really like to see is an entry point in this particular area that's highlighted here. 50 point is fair market value. Anything below that, we have hit below that this week and popped. But we really would like entry possibly here. This is why I talk about if this is the dip. This might be the turnaround. We might get a higher low as long as we don't hit that 36.36. But ultimately, I think we're starting to see fear in the market. So you have to be careful, because if this doesn't hold, this very well could come back down here and then potentially break. So that's something I'm watching very closely. But again, could be pivotal. I don't think we're going to go back to all-time highs anytime soon. I think the housing thing is playing out slowly, and we're starting to see that. Again, if the Fed do decide to dial back, my sentiment for the market could change. And I do believe it could go back to all-time highs, but it really weighs heavily on what the Fed's actual actions are. Not what they're talking about, but what their actions are. And that's what the market is waiting on. They want to see action. We've heard a lot of talk about different data they're going off of. So people try to play, well, if I look at these particular data points, maybe I can understand what's going on, and then come to find out that it doesn't even matter. None of that matters. It's on what action is actually going to be taking. So that's why there's more weight on the ECB interest rate decision. So there's more weight on the core CPI. That's why there's a lot more weight on monetary policy. Because of these things. Everything else, people are starting to get irritated and bored with the fact that none of it's going to make sense, because everything that they said that it was, it's not. And that's the way it always typically has been. So nonetheless, again, really watching this zone. I think we could dip all the way down to the 3,800. That would put us roughly around that 75-point basis move, what we've been talking about. And I think we kind of float here essentially till the Fed, to be honest, at the end of the month, unless we get some really good numbers from the ECB, unless we get some really good core numbers from the ECB. And when I talk about really good numbers, I'm talking about like dipping down to like 5, maybe even 6. If we get like a 2 percentage drop, I think that would be big, and the market might take that very positive. If we're talking like just a 0.5% or a full percent, maybe, but you have to see a bigger change in that core headline for this to really come down. And to make this churn start running up towards back half of the year. Again, I still see a back half of the year run, and then what I'm talking about actually playing out in the beginning of next year, because roughly you have a sell-off around February and March time period. End of February, early March, you have a pretty big sell-off, a pretty big dump, and I think around that time, that could be the catalyst with the bankruptcies and everything else that would cause the market to crash at that point. But it's not saying it would make a new low. We don't know. To be honest, if it holds here, I don't think we could make a new low. Might see a really good correction again, but maybe not make a low. We're just going to continue to see this chop for the rest of the year. It's a very strong possibility in my mind. So let's look at Bitcoin. Bitcoin's still holding. Again, it cannot break essentially that 18K 500. Won't really need it to hold that, or else this is coming down pretty low, at least at the 15, in my opinion. Again, you got a lot of psychological levels. 15, thinking like 5K increments for Bitcoin. Once it gets below 10, then you start looking at what potentially 1K increments at that point, as far as psychological levels. So again, really going to just depend on the general market for this one. The dollar still sitting at 109. It sat at like 106, 107 for the longest time, and then it's really ran back up, which is definitely not a good thing. What's really odd too is oil is starting to drop. So that's something that is a bit odd to see. So we do have to keep an eye on that. Bonds is something I haven't really talked about because bonds really haven't moved a lot, which is really interesting, especially with everything that's been going on. So we want to kind of keep track. We could be getting a double bottom here at the 108 mark for bonds. Now, again, it doesn't matter if this goes up or down. It doesn't really have a. If this goes down, it's not the inverse of the market. Sometimes they run in parallel, sometimes they don't. Again, the biggest thing with bonds is the volatility within the bonds. As you can see, the volatility in the bonds, it hasn't been too bad. When there starts to become a lot of volatility in the bonds, the market will sell or it'll go higher very quickly. So just be mindful of that. And when the volatility again moves in here, that big corporations are buying and selling in the bonds, and that can drive or push hopium if the bonds start having a lot of volatility one way or another. It just depends again on the sentiment of the market. But again, that's why essentially you watch the bonds, not so much that they run in parallel or not. Again, it's just all about volatility when it comes to bonds. BA is the other one we are looking at. BA, again, it finally broke this week. It finally broke this 157. I talked about this getting retested, consolidated for such a long time. We were starting to head lower. We're starting to get out again earning mode, and then I think we're going to set up for the next earnings. But this thing is going to pull back quite a bit and see if we can get this down pretty far. I got support at 140. Got another support around 120, and then you got the bottom sitting roughly around 116. So it's not saying this thing is going to flush that far this week. Could get a nice push potentially down to the 141, the 135, potentially by the end of the week. I think it's a strong possibility, so especially if the ECB does bad. I think we can get a pretty heavy second leg down, and then it really determines if that's going to be the pivotal point that we run or we continue to tank. So, and then JPM, again, holding well, try to push, got rejected again, needs to hold the 111 mark this week. If not, going to go back to potentially those lows of 106, and then we'll see if that breaks. Again, the market sentiment, if the market is bad, everything looks the same. So I can show you a chart on everything. It's not really going to matter. It's all going to look the same. That's why I think if you had if someone's trying to give you a massive list on different things, I think that is wrong and incorrect because everything's going to move in parallel. Some things might move faster. It really just depends. It really depends if you play both sides, right? If you play puts, you might get a better position on those things that have pumped more, or if you play calls potentially on oil or something else that's rebounding. I used to play oil a lot. I don't play oil hardly at all anymore. I can't remember the last time I played oil, to be honest. I'm more so big tech and index at this point, and I think that's primarily where a lot of people should focus on because the index is moving more than a lot of these other individual stocks are at some point. So. But that is pretty much what I got. I don't want to make this too long. Again, it's really basic. There's a lot of kind of information in the beginning that's really important on what to be looking for. I try to make it simple. I think keep it simple. Strategy will help you a lot in the long run. And until next time, I'll see you guys later.